This is yes or no with a gun to your head. Is QE money printing?
Yes.
You're going to make me do this?
I'm going to make you do this.
All right. I'm going to get out this. I'm prepared. This is from the Bank of...
Keep the mic near to your mouth.
Let me get it up first. This is from the Bank of Canada. And you can all go on their website and see it. There is a common misconception that we are just printing money, but that isn't the case. We pay for these purchases with settlement balances, with their bank reserves. In effect, settlement balances act like loans from financial institutions to us. When we buy assets, we borrow from financial institutions by crediting them with a deposit of settlement balances in the accounts that they have at the Bank of Canada. Like deposits that you may have at your bank, settlement balances are an interest. Right now we pay an interest rate, blah, 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 blah. No, it's not money printing. It's an asset swap.
Sorry, Lynn, but is he wrong?
I'll point out that nobody more than a central banker wants you to think that QE is not money printing. So of course the central banks are going to say it's not money printing. And when I hear the asset swap thing, one thing I point out is that it is an asset swap. You have to ask what happens before the asset swap. Did they have an asset that then they swap for something? Or did they create an asset that they then swap for something? And so it's not that it's not an asset swap, it is. It's that they create a reserve and then they swap it for something. So you have a situation where, let's say they're buying government bonds, the government is in a position where they're selling bonds and they're not pulling capital out of the market. They're not, if I have dollars and they sell bonds to me and I give them dollars, they're pulling dollars out of the economy and they're putting treasuries into the economy. And from my perspective, I don't really care if I'm just using them as savings. And maybe they do it for foreign sector, maybe they do it for other sector, but if they run out of buyers or if they want to jack up asset prices, they say, okay, we're going to sell bonds into the economy, which allows us to spend money into the economy. But instead of pulling that out, we're not pulling dollars out of anybody. There's no real buyer that's buying these bonds. It's that the central bank is creating bank reserves and then buying the bonds. The caveat where the money printing question becomes relevant is that if you're just doing QE without super large deficits, or if there's loan destruction, like defaults that are happening that are bigger than the deficits, then it won't be inflationary because you're not just sending money to people. The biggest kind of combo that really becomes money printing is when you have very, very large fiscal deficits, especially ones that are direct to, not the top 1%. If you're actually sending people PPP loans to turn into grants, if you're sending them stimulus checks, and then you're financing that by QE, by QEs to finance that fiscal spending.
I think you're dancing around the limitation here.
Talk to us about so we can.
Because what you're saying is that the central bank causes money printing when the commercial bank acts in response to the asset swap, right? Because ceteris paribus, nothing else would have happened. And I think that's a faulty assumption, which is why we never see any effects from QE in any marketplace. Because the assumption is that commercial banks act in response to what central banks are doing, when commercial banks have their own limitations, which is what always thwarts quantitative easing. Because the central banks want the commercial banks to act in response to this, exactly how you say it. But that's not the limiting factor. It's not the level of bank reserve. It's not the central bank purchases. It's the banks have their own internal constraints, usually volatility and liquidity constraints of their own that forces them to then just do this basic asset swap. They're more than happy to swap a treasury bond for a bank reserve, scalping a few pennies along the way, because they're constrained in every other balance sheet way. So that's why it never becomes money printing, because money printing is done by the commercial banking system, not the central banking system.
Let me put it this way. Every single time when a government gets over, say, 90, 100% debt to GDP, one of the biggest buyers of the government bonds becomes the central bank. And it's because you start to get so lopsided in terms of how many debt securities are in the market versus how much money's in the market that you need to create more money to buy those bonds. And I think the key thing is to realize that if you're...
But then why isn't it inflationary?
Because it's not combined with fiscal spending. So, for example, if you look at the Japan...
So QE is dependent upon the fiscal authority? I mean, again, you're not talking about money printing.
You are, because for example...
No, go ahead.
No, go ahead.
I was just going to say that the whole point of money isn't necessarily the money stock. We have to keep in mind it's the money in circulation. That's
Yes.
always been the the factor that decides whether something is money printing or whether it's inflationary or deflationary is how much money is actually circulating, which is why the limiting factor is the commercial banks, because the commercial banks, along with non-banks nowadays, they're the ones who actually do the circulation. So if the central bank wants commercial banks to circulate money and commercial banks don't want to do it, this is exactly the problem that the Japanese have had along with every QE in existence. It always ends with the commercial banks. And believe me, the central bankers know this. And they would love for you to believe that QE is money printing. In fact, Jay Powell went on 60 Minutes in May of 2020 and fucking lied his ass off and said it was digital money printing. He said, I flooded the world with digital dollars. So the problem is the commercial banking system. It's always commercial bank factors. In fact, commercial banks don't need reserves. If they were free from constraints, they wouldn't need any reserves at all. They would just use the same forms of liquidity that they used for decades. That's why there were practically no bank reserves in the system before Lehman Brothers. There was never more than 10 billion because commercial banks settled based on their own practices. So if commercial banks want to do money circulation, they don't need the central bank to do it for them. In fact, in my view, central banks do QE in response to the fact that commercial banks aren't acting the way they're supposed to.
Can I just interrupt for 1 second? I think
No, we're talking here.
there's going to be some people in the audience that are a little bit lost, including me. Can we just go back to explaining like precisely what QE is, so we can know exactly what we're talking about here?
And will you agree?
No.
Lynn, from your side, QE is?
QE is basically when the central bank creates more bank reserves and then swaps them for some sort of asset, usually a government bond or a mortgage-backed security, or in rarer cases, it could be other assets like the Bank of Japan will do it with equities. But normally, the most common one would be government bonds.
Jeff?
Yep, that's it.
And I think so.
That's the mechanics of QE. Yeah.
And so going back to your point, for example, during COVID, there was a huge spike in bank deposits. So not just bank reserves, but bank deposits. And so, there are people, for example, you're working as a school teacher, you had $10,000 in the bank, the government sends you money, it shows up in the bank. Now, if that was not financed by QE, it'd be coming out of other bank reserves somewhere. It would come out of bank deposits and bank reserves. But because they were able to inject that without pulling it out of anywhere else, they actually increased the amount of broad money in the system. And in that example, it was not from bank lending. Banks were not doing excessive amount of lending during COVID. Instead, it was the fiscal stimulus going around the fact that the banks weren't lending. And so if you go back to, say, the 70s and 80s and things like that, that inflation was not because of QE. It was not because of large fiscal deficits, although they weren't helping. The fiscal deficits weren't helping. It was primarily because of demographics and bank lending in the 70s. That's where most money creation was coming from. Whereas the biggest ever spikes in broad money supply, so let's call it bank deposits plus currency in circulation, the biggest spikes ever in those were the 40s and the early 2020s, and that was when things seized up, banks weren't lending, and there was very, very large fiscal deficits that were then monetized by the central bank. So it's especially that fiscal plus QE combo. And you can imagine, in March 2020, the treasury market completely froze. Bid-ask spreads blew out, liquidity blew up. The foreign sector has tens of trillions of dollars of assets. They were starting to sell hundreds of billions of them for dollars because they had a dollar shortage, which you cover all the time, all the Eurodollar stuff. They're selling assets to get dollars, and the whole thing seized up. And so if you have a completely liquid treasury market and the treasury says, bad news, we're about to issue trillions more treasuries into a liquid treasury market that foreigners are actively selling, that's where the Federal Reserve comes in and says, well, we have a solution. We're going to create more base money and swap them for those treasuries so that you're able to finance that even though there's nobody in the real world who's actually swapping dollars to get these treasuries. You're unseizing an illiquid market because of that.
Look, I'm going to disagree with a lot of that because the treasury market was already illiquid. In fact, the treasury market, that's a misconception that the treasury market is entirely liquid. It's not. There are actually two different parts of the treasury market. There's something called off the run and on the run. And what happens all the time is that foreign reserve managers park their reserve assets because they don't trust the Fed and they don't trust the Eurodollar system, nor should they in either one. They park their assets in illiquid, off-the-run treasuries because they don't need to be liquid. You're just holding them until maturity, recycling through them. Maybe you have to sell one every once in a while. And in March 2020, as you pointed out, was because of a massive dollar shortage, reserve managers had to suddenly sell these treasuries in which there was no ready market available for them. So the treasury market didn't break down, the dollar system did, which precipitated the selling. The on-the-run market was still functioning relatively well because the on-the-run market was where all the demand was. So the idea that the treasury market broke down and the Fed needed to come in and save it is a misconception. There is no liquid market for off-the-run treasuries. The more interesting part of March 2020 was why did everybody have to sell in the first place? And this is the story we're getting into now with why are banks failing over the last couple of months. It's why are they forced to sell assets? And they're forced to sell assets because they have a liability mismatch, a liquidity problem, a dollar shortage. And the Fed didn't fix it by buying up off-the-run assets. They didn't do much for the repo market to begin with. So
What kind of dollar shortage did they have? Because my understanding of the bank crisis recently was because they were holding treasury bonds and they were long duration. There was a run on the bank, so they just didn't have the assets required to service their clients.
no, they could have been fine. The problem is
How though?
those assets
But
were
they weren't
underwater.
fine.
What's that?
But they weren't fine.
Yeah, but they weren't fine because they were forced to sell them.
Why were they forced to sell?
Exactly.
Well, there was a run on the banks.
There was a deposit run because regional banks have been bleeding cash for well over a year, going back into early 2020. And the real interesting systemic dollar shortage question recently, not March 2020, but recently, is why they aren't in the wholesale markets to borrow all those funds back. And SVB tried to go in the wholesale markets. We don't really have a real answer to this yet. Because all you really need to do if you have a bunch of illiquid assets on your book is liquefy them. Package them in some form of collateral package, go to Goldman Sachs and say, I want to swap treasuries and borrow funds in the repo market. Why didn't they do that? Why didn't SVB go to the Federal Reserve?
Because there's not enough reserves in the system.
There's $4 trillion.
Yeah, which is not enough.
How is that not enough? We used to have a functioning economy with less than 10 billion. So how can we now have this overwhelming need for $4 trillion?
Because of the other assets that are growing even quicker. So, for example, the amount of foreign assets that are owned. So the massive growth of the treasury market. One thing to think is that every security in the market is basically a claim for dollars, right? So we have tens of trillions of dollars locked in the equity market, tens of trillions of dollars in real estate, tens of trillions of dollars in bonds. And technically, any owners of those securities can sell those with the expectation that they can get dollars in return. But of course, the problem is that you have literally over $100 trillion worth of these assets and nowhere near as many actual dollars, especially base dollars, let alone broad claims on dollars, to actually satisfy those. So at any time when you have a higher than normal amount of net selling for these types of assets, you get a liquidity problem. And we don't just see this in the US. So for example, going back to say let's start with the US for a second. So for example, during the COVID crash, and then actually again during the gilt crisis in like September, that kind. So if you look at, before we get to the UK, if you look at the US market, both those times in March 2020 and in September 2022, the treasury market was getting really illiquid and wobbly. And in March 2020, it was the off-the-run securities that had the biggest issue. But if you also look at treasury auctions, so brand new treasuries coming to market, you were getting like fat tails on these auctions. And so a sign of a successful auction is that, when you're bidding the treasuries out, the first price and the last price shouldn't be very different, right? Because it's kind of like there's far more buyers than you're selling, and the first security sell, the last security sell are basically the same price. When you have like a sloppy auction, there's like not enough buyers kind of, and it's just like really shaky, there's bad liquidity. You get a long tail where like the final security sells for a much worse price than the initial security. And you saw that both in March 2020, and then you saw it again in September 2022. But then, of course, a worse example was what happened in the UK, where they come out, there's high inflation, they're about to pivot and start doing QT, and then they come out and say, hey, we have this new budget, bigger deficits, we're going to issue a ton more gilts, UK sovereign bonds. The market throws an absolute fit. Yields spike. But then, of course, the problem is that all these pools of capital hold these assets on leverage, all these pension funds. So they have to start selling. And then you have, it goes back to the thing, there's so many holders of sovereign bonds, and all of those are claims for dollars. And so if you get tons of sellers, well, in this case, pounds, you have all these claims for pounds at the same time, and it just would completely liquefy itself, and there's just not enough pounds to meet that demand. So what happens? The Bank of England had to literally cancel a speech. They were going to talk about balance sheet reduction. They had to cancel a speech the next day and be like, just kidding. Even though there's 10% inflation, we're going to go ahead and create new bank reserves to buy these gilts because too many of them are selling at the same time. And so it's a reliquefaction. It's basically a buyer of last resort, not with existing dollars, but pounds, but with brand new pounds that are just created out of thin air to take those off the market for the fact that there's no actual genuine buyers of them at these prices.
But that's the point, that the liquidity, you're right, every asset is a claim on dollars, but those dollars are not physical dollars, they're not government dollars. Most often, they're bank claims. They're a claim on a bank. And so the problem with liquidity is not that there aren't reserves, it's that there aren't enough banks that are willing to create those dollars to settle that claim. And so the shortage in money, whether it's UK pounds or anywhere else, it doesn't really matter because everything's always on the other side of the dollar, is that there was a shortage of bank capacity, or really banks willing to take on that settlement liability. So it's a shortage of banks, not a shortage of bank reserves.
I think one way of looking at it, going back to the global financial crisis, right before all that broke down, there were, I think there were 64, if you look at how much debt was in the system compared to bank reserves, there was like a ratio of like 64 to 1. So there's like 64 claims on dollars just from debt, let alone equity, just from debt, like dollars that are literally contractually owed to you in the future at a specific time. There are 64 times as many dollars owed to security holders as there were dollars. And if you're running a bank, you're kind of running it based on faith, that not too many people are going to come back and ask for dollars back at the same time, where you're holding all of these illiquid securities. And you're operating in the system where there's far, far more claims on dollars than there are dollars. And back then, they had a system because they had so few bank reserves that if 2% or 3% or 5% of your deposit base comes back at the same time and wants dollars, you have to do all these gymnastics with other banks to make sure you can meet that liquidity redemption, which works for one bank. The question is, what if the entire banking system, what if 5% of people want to pull their money out? Or phrased another way, what if people want to pull 5% of their money out, not from one bank, from the banking system? And the answer is you can't. There's not enough dollars. And so we kind of saw a similar thing in these recent banks, where now, because of what happened in global financial crisis, there's higher liquidity requirements, there's stronger capital ratios, things like that. And so banks don't want to be caught out with just having, say, 3% of cash as percentage deposits or 5% of cash percentage deposits. They want to have way more because you have to be able to meet just arbitrary bank runs, especially ever since March of 2023, where at any given moment, even a healthy bank could face 10% of people want their money back.
Doesn't that argue for a shortage? Because what you're essentially saying, and you're right, I agree with you, the banks have enormous liquidity cushions because they're basically telling you they don't trust the Fed. Bank reserves are not useful as a form of liquidity. If they were, you wouldn't need the liquidity cushion. We would go back to the way it used to be before, where liquidity was created by the banking system itself, because not everything is settled in bank reserves. In fact, there was a time when most financial transactions were settled privately between banks. The old correspondent system, what's still left of it. So the fact that banks feel they need to hold massive amounts of cash, as well as massive amounts, constant access to massive amounts of on-the-run treasuries, basically tells you they don't trust the system.
I think the thing is to separate one bank from all banks. And so, for example, that system worked on the premise that the system itself was stable and that any one bank or any small set of banks could get liquidity from other banks at any time. Whereas when the system gets over-leveraged enough, like it was in 2007, which was like the peak of leverage, private sector leverage, you have a situation where it's not just one bank that has a problem, it's that the entire banking system, far and wide, that there's so many claims for dollars, relative to base dollars in the system, which are liabilities of the Fed, either in physical form or in bank reserve form. And so the whole system becomes such that if just a tiny single-digit percentage of people want to have physical cash or want to, sell something for cash, even digital cash, they can't. And so I think the key thing is the difference between just one bank needing liquidity, which there's all manner of ways to do it, versus the entire system is short liquidity because there's not enough bank reserves. There's not enough actual cash in the system. And back then it was because you had, bank reserves were growing very, very slowly while claims on bank reserves. So every deposit in a bank is basically a claim for a bank reserve. Every debt instrument is a longer term claim for a bank reserve. And the number of those claims was growing like exponentially to the tens of trillions, while the number of bank reserves was growing like practically linearly, and it was like, hundreds of billions. And there's just, eventually the ratio got so big that we haven't seen it since like the 30s or, since like 1929, and it blew up. And we've kind of seen a similar thing more recently. And it's a difference between system versus one bank.